In this episode, we'll be looking at finding buys after a market sell-off. Now, the reason to look for buys after a sell-off is because in the short term, stocks have shown a tendency to revert to the mean. Now, we can think of the mean as the 3-day moving average, as shown in this picture. And what we see is that prices move above and below that 3-day moving average. The 3-day moving average serves as the mean, and when prices get too far away from the mean, we expect them to snap back towards the mean and eventually cross it back above it. This is the idea of an oversold stock. When the stock is too far away from its average position, we expect the bounce back. Now, there's a number of ways to measure whether or not a stock is oversold. The 2-period RSI has been one that we've written about for many years and has proven to be an effective tool. In subsequent research, we discovered Connor's RSI, which adds to the value of the RSI by measuring the length and duration of the oversold condition. Connor's RSI is a unique indicator in that it combines multiple aspects of oversold into a single number and provides a more precise snapshot of whether a stock is oversold or not. You could use short-term moving average or moving average crossovers. A combination of the 3- and 5-day moving average or the 5- and 10-day moving average with extreme deviations from the moving average being another possibility. Bollinger Bands, when a stock moves very far above or below an upper or lower Bollinger Band, also provide a way to define oversold conditions. The important thing in the stock market is to quantify your observation. Just because prices have fallen dramatically does not mean a stock is oversold. And just because it's oversold does not mean that the stock is a buy. Not all oversold stocks will rebound quickly. Some, in fact, never rebound. In order to find the best candidates, we've found it's best to apply several filters. An example is found in several strategy series books, including the 2-period RSI pullback trading strategy. We'll be using part of that strategy to identify a candidate in this presentation. The first step is to limit the risk by buying pullbacks during uptrends. Research has taught us that using the 200-day moving average to identify uptrends is one of the most effective ways to limit risk. Buying only stocks above their 200-day moving average helps dramatically improve the trading results as compared to buying stocks when they are below the 200-day moving average. By inserting the 200-day moving average filter into this strategy, we are ensuring that we're buying short-term pullbacks during long-term uptrends. We also trade only liquid stocks. This helps us to minimize the trading costs and also avoids the risk that liquidity will disappear when we need it to get out of a stock. This is especially a problem in down markets and in stocks that are oversold. So we limit our selection to stocks above their 200-day moving average with a high degree of liquidity. A filter such as average trading volume greater than 250,000 can help you to filter for liquidity. Then we filter for volatility. And the reason for this is a high volatility stock is likely to make a quick bounce back. A low volatility stock may bounce back slower over time. So by limiting ourselves to high volatility, and we use indicators such as Connor's historical volatility measured over the past 100 days, or the 10-period ADX. When the 10-period ADX, which is a widely available indicator, when it's over 30, the stock is generally trending and is worth taking as a trade candidate. Then we identify stocks that are in a short-term downtrend. In this case, we're looking for stocks to close lower in 3 of the last 4 days. Many traders require consecutive down days, but we've found that's not necessary. Rather than requiring just 3 down days in a row, requiring 3 of the last 4 days to be down improves our performance by increasing the number of high probability trading results. You could, of course, use more down closes, such as 5 out of the last 6 days, or other parameters. To time entries, we can use the RSI2 or the Connors RSI. Generally, when values are below 20, a stock is oversold. The lower, the better, as far as win rate goes and probability of success. Even RSI2 less than 20 has a very high probability of success. Lower values, of course, are better for more conservative traders. And as we've noted, RSI2 works well, but in additional research, we discovered Connors RSI, and it is an improvement. Once you've identified candidates, which are simply stocks in a short-term pullback during a long-term uptrend, we found it's best to enter on additional weakness. Allow the stock to pass as a trade candidate if it opens higher. That one got away, so to speak. You can put in a limit order for the next day to buy the stock 4, 5, 6% below its close. To exit the trade, you can use a short-term moving average. If the stock is sufficiently oversold, it'll be below its 3 or 5 day moving average. A close above that would be an indicator to close the trade and look for the next short-term opportunity. You can also use the 2-period RSI or Connors RSI to exit a trade. Because these positions are oversold with an RSI2 or Connors RSI below 20, an exit signal such as RSI2 or Connors RSI greater than 50 or 70 work very well also. Here's a potential trade setup that we identified using a screener at finviz.com and then created the chart using TradingView. This is NVDA. As you can see, it's down. In fact, this one is down 3 days in a row rather than 3 of the, so it meets our requirement to be down in 3 of the last 4. Connors RSI has fallen below 10 in this case, and it's been oversold now for 2 consecutive days. TradingView allows you to put up historical volatility. We use a 100-day period. It also allows you to put up an ADX. This stock passes both of those criteria. The stock closed at 27.11. Depending upon your desire for risk, your acceptance of risk, you would set a limit order to buy 3 to 6% below the closing price. If the stock opens the next day on additional weakness, you'll be executed and you're in the trade. If it turns higher, you'll have another opportunity to find a short-term trade. By buying on additional weakness, we have found that you reduce risk overall. Sometimes the stock will bounce back immediately and then continue lower, just a simple dead cat bounce. By waiting for that additional weakness, you increase your opportunities of success. We wish you well in your trading endeavors and remind you that tradingmarkets.com has a number of trading tools that can help you to succeed. Thank you.